Okay, next we're going to talk about vehicle expenses. Vehicle expenses, when it comes to record keeping, I think of vehicle expenses as a black hole. It's the single most audited expense on what is already the single most audited form. So the Schedule C is the most audited form, and vehicle expenses are the single most audited expense. So what do we think we have here is, kind of a is kind of an invitation for a problem. I like to be kind of strict with my clients about this. I think that, I think I said in part one, we almost kind of want to scare them a little bit because, when you have an IRS mileage audit, you should be a little scared. Okay, the issues that we deal with when it comes to vehicle expenses are, first off, deductible mileage versus commuting mileage. Very few people understand this right off the bat. I find myself drawing a lot of diagrams on scratch paper to explain, okay, now, you went from home to where, and we sort of map out a day for them. And then I say, okay, this is business mileage. This is not business mileage. And, after I go through a few examples, then they get it. But we do have to go through the little picture drawing process. Standard mileage rate versus actual expenses. This is a tough one. Boy, so many small business owners, they just think that the Schedule C is kind of an opportunity to deduct everything. It's almost a license to, I'm going to say license to steal. I don't mean that literally, but a license to just put everything possible in as a business mileage, and then we wonder why there's a loss year after year after year. It's really not good practice for the micro business owner to be putting all his vehicle expenses, all the vehicle repairs, the insurance for the vehicle, everything on that micro business credit card. It's a bad practice. Almost always those vehicles are mixed use vehicles. Very few micro business owners have one dedicated vehicle for the business, and everything else comes on is on a personal vehicle, a separate vehicle that's never used for business. I think I've seen that one time. Okay, everybody else has got mixed use, and what they want to do is they just want to swipe that business card just as fast as possible and have everything paid by the business. Bad plan. And then the third issue that we deal with is Jeff's favorite thing, yay, depreciation. And we're going to talk about that shortly. Okay, so let's start with what is business mileage and what is commuting mileage. This is the sort of thing that I like to draw, except that my drawings don't look this good, by the way. What is business mileage? What is commuting mileage? Without a home office, driving from home to the first business stop, see the red arrow? Red means no. Red means this is commuting mileage. It's not business mileage. And invariably at this point you hear, yeah, but I live so far away from my work. This is a personal problem, okay? And we all know the IRS's opinion of personal problems, right? So when we drive from one business stop to the next business stop, that's deductible mileage. I tell my real estate agents, when you drive, if you don't have a home office, when you drive to your realtor's office, that's commuting mileage. Then if from the realtor's office you drive to show a bunch of homes, that's business mileage, yay. And then that last stop of driving home, once again, that's commuting mileage. If you stop to pick up your kid from school on the way, the business portion of this program has now stopped, and everything after that is personal mileage. It's hard to get this through because it's not what people want to hear. This is not what they had in mind when they started their micro business. Now, with a home office, this is one of the wonderful things about the home office. All the arrows are green. Yay! Yay for green arrows. So if it's as long as all of the trips throughout the day were for business, then the whole trip gets to be business mileage. And again, there's no reason, in the world for people to be complaining about this anymore. The days when we had these giant log books where we kept, mileage records, that's gone. All these lovely mileage apps just make everything so easy. But again, I tell them, make sure that you can print reports out. And I just say this jokingly, because we're not going to send your cell phone to the IRS. And then, they snicker and then they get the general idea. Okay, so standard mileage rate versus actual expenses. Now, I personally think that the standard mileage rate is a smoking deal, okay? For 2017, it's 53.5 cents. For 2018, it's 54.5 cents. I can't remember what year it was where it actually changed mid-year just to make our lives a little more exciting. So typically it's based on the price of gasoline. Now, in addition, to the standard mileage rate, you also get to deduct a percent of interest on a car loan, a percent of vehicle license tax, and parking fees not at a workplace. And the reason that you get to deduct this is that the standard mileage rate is not taking these things into account. Now, the problem with these percentages is that in order to take the correct percentage, you have to know what your full mileage is. Okay, the percent that you're getting to deduct here is the percent that's applicable to business. So now, not only do we have to be keeping track of our business mileage, we have to know what the mileage was for the whole year in order to get the correct percentage. This is a lot of record keeping for your average micro business client. I get a lot of, I'm going to say, feet dragging when it comes to this kind of record keeping. Once in a while you find people who really get into it and they really like it, but that's pretty unusual. Okay, so then actual expenses, that's an option, is the percent of gas, repairs, maintenance, depreciation, interest, vehicle license tax, plus parking fees not at the workplace. Now, again, a lot more record keeping and a lot more receipts to keep. Imagine keeping the receipts for all your gas, your repairs, everything you've had done to this car. It's a lot. But the depreciation can, for the actual expenses, can result in a pretty big deduction. And this is something we're going to talk about shortly. And that's a selling point for the actual method. Now, is the taxpayer stuck with his first choice? Good question. Now, the taxpayer can switch back and forth from standard to actual only if he elected the standard in the first year of service for that vehicle. By the way, side note here, I have clients that seem to switch cars like they change clothes. I don't know if it's just my clients. I have clients, it seems like every year it's like, well, let's see, from January to May, I had a Nissan, and then in June I traded in for a Chevy, and then in November I saw this, and it's, wow, it's just mind-boggling trying to keep up with this stuff. So for the first year of any given vehicle's year of service, if they start with standard, then they can switch back and forth. If they start with actual, then they're stuck with actual. For a lease vehicle, I get asked a lot, I'm sure you do too, is it better to lease a vehicle or to own a vehicle? To me, that's not a tax question, it's a money question, so I try to put that in perspective. But if they want to use standard mileage for a lease vehicle, then they have to use it for the entire lease period. There is no switching back and forth for leased vehicles.